Apart from equities, which have been grabbing most of the headlines lately, another asset class making waves is sovereign gold bonds. With the Reserve Bank of India recently allowing premature redemption of SGBs issued between May 2017 and March 2020, speculation is growing that the government might be hesitant to issue more of these bonds in the near future. Given this speculation, all SGBs listed on the secondary markets are currently trading at a premium of up to 12%. The highest premium is observed in the latest tranche, which was released on February this year, which is trading at 8,075 rupees per gram. This tranche was originally issued at 6,263 rupees per gram, which now reflects an impressive 29% increase in just 6 months. Now let me explain first how this SGB works. Launched by the government in 2015, SGBs provide a convenient way for individuals to invest in gold without the hassle of physical storage or risks associated with theft. Unlike physical gold, SGBs have no storage costs or making charges. These bonds are linked to gold prices, so if the gold price appreciates, your bond value goes up. But you may ask, how is this different from buying and selling from the commodity exchange or buying gold ETFs? Here's the clincher. These bonds come with the added benefit of a 2.5% annual interest rate. Now, this setup means that an investor earns a steady interest income of 2.5% per year, regardless of gold price fluctuations. While traditional bonds focus solely on interest income, SGB investors benefit from both the annual 2.5% interest and an increase in gold prices, which is allowing for dual source of returns. Plus, when a gold price goes down, you will incur a loss, but you will still continue to earn the 2.5% interest on the bond. This makes SGBs an appealing choice for investors looking to diversify their portfolio beyond conventional bonds and equities. How can investors invest in these SGBs? Now, each SGB is denominated in grams of gold with a minimum investment requirement of 1 gram. Individual investors can purchase these bonds in increments of 1 gram exceeding up to 4 kilograms, whereas individual trusts can buy up to 20 kilograms of gold each financial year. So instead of buying physical gold, investors could participate in these bonds that earned a fixed annual interest rate, and these returns, mind you, are completely tax-free post 8 years of maturity. Investors also have the option to redeem these SGBs after the 5th year. But the twist here is that if an investor chooses to redeem their SGBs before the full 8-year term, they face a 12.5% long-term capital gains tax if sold through the NSE exchange window. Now coming to which series have RBI called for an early redemption. The RBI announced early redemptions for 156 series of SGBs issued from May 2017 to March 2022. This process is expected to take place in 2 phases starting on October 11, 2024 and concluding on March 1st, 2025. The first tranche eligible for redemption is the 2017-18 series issued on May 12, 2017. Investors opting for early redemption will see their proceeds deposited into their bank accounts by November 12, 2024. Investors can either redeem their investments through secondary markets or when the RBI buyback window opens up. But should investors opt for this early exit option? Market experts recommend that investors hold on to their SGBs until it reaches its full maturity of 8 years to maximize their returns, especially since gold is currently experiencing a strong rally and gains from SGBs held to maturity are exempt from taxes. Now let's understand this through an example. The intrinsic value of Series 3 of the Sovereign Gold Bond tranche, which was issued on August 14, 2019, is currently at 3,258 rupees per gram, with 3 years of coupon payments still remaining. However, this bond is trading on the NSE exchange at 7,601 rupees per gram, which reflects a 6% premium based on the 3-day average gold price. The issue and redemption price of the bond is defined to be the 3-day average price. Now, if investors decide to redeem the bond at this market price, they would make a profit of 4,343 rupees per gram. But there's a caveat. This profit is subject to a 12.5% long-term capital gains tax, which we earlier mentioned, and now this taxation will eliminate the entire premium gained on the exchanges and reduces the profit by an additional 6.5%. So what's the better strategy? It would make more sense for an investor to hold on to the SGB until it matures in August 2027. By doing so, they would be exempted from any long-term capital gains tax and can take advantage from the gold appreciation. In simple terms, rather than cashing in on the current premium, which ultimately reduces profit and offers no real advantage, investors would be wiser to hold on to their SGBs until full maturity. And given gold's dazzling run this year, the buzz on the street is that this golden rally is far from over. So far this year, this bullion has already surged 12%, where in August alone saw a glittering 4% rise. Market experts believe that the gold uptrend will continue from here on. Now here are the top 3 reasons why. First up, a possible rate cut. Last month, Fed Chief Jerome Powell dropped a hint at the Jackson Hole Symposium, suggesting it might be time to trim those interest rates. The market's already bracing for a modest 25 basis point rate cut in September, but if the Fed decides to go bigger on rate cuts or starts to sound even slightly more dovish, it could set off a fresh surge in gold prices. Secondly, the Middle East tensions. Last October, gold prices shot up as tensions escalated in the Middle East. Now, as we approach the anniversary of Hamas' invasion of Israel in October, the situation remains tense, with Israel blatantly refusing to sign the ceasefire deal with Hamas. Hence, any flare-up could send investors flocking to gold, the ultimate safe haven, pushing prices higher still. Finally, the upcoming US elections. While elections don't typically rock the gold market immediately, the policies of the new president can definitely shake things up. With so many global uncertainties in play, a turbulent election season could very well boost the demand for gold. As of now, the RBI has issued 67 SGB tranches, raising 72,274 crore rupees from these investors. Of these, 4 have fully matured. The remaining 63 tranches are still pending maturity, with the RBI expected to pay nearly 1 lakh crore rupees to investors, excluding annual interest rate.